Welcome to Late Nights with your host, Mr. Grassini. Hello, everybody. How is everybody? And, it's come to my attention that most of us can't sleep. Most of us cannot sleep. So I've decided to bring on something a little bit more indulging, unique. So this is called Late Nights with your host, Mr. Grassini. Yeah. So, how is it that we always up at these odd hours, man? How is it that we always up at these odd hours? Analyzing charts, looking at situations where, I don't know, we can better ourselves. Grinding, yeah, but why is it that we can't sleep? Why is it that we can't sleep? What is it? What is it? Why is it that we can't sleep? All right, so we're grinding. We're grinding. So who's trading? Who's been looking at the chart? Who's been trading? And if you've been trading, what are you trading? What is your analysts look like? English never loved us. Hey, well, my chart looks something like this. Where is it? Oh, there we go. So who's analyzing? Who's analyzing the charts? Me. We're all analyzing, all right? We're all analyzing. What I've seen though, right, is that this level hasn't been mitigated yet. I'll show you guys now. Because this is my level of interest. I feel like the market could definitely come down to this level. So I could definitely see the market coming down to that level. And was this mitigated? Yes, it was. Last down candle. We didn't break. We broke this high. Right? We broke the high over here. Was this candle mitigated? No, it wasn't. So this level again could hold. Right? And then here was the low broken. No, it wasn't. Was there mitigation? No, there wasn't. This level can hold. All right, so these are the levels that I see pretty much holding. And obviously that level over there, what was not mitigated, so you could probably see it holding, and yeah. So these are my level of interest, guys, which I'm going to show you now. And I just feel like these are levels that the market has respected and continue to respect. So I don't see why anything should change. So yeah, let's get into it. So we have that order block over there. We got the touch of, oh, wow, what a mitigation over there. Beautiful. So, all right. Okay. All right. Great. Okay, so these are my levels of interest. Now, why do I choose these levels? Well, if you can see over here, right, that was the last down candle, right, before the up movement. The up movement happened over here. Let's zoom in on this quickly. Let's zoom in on this. Let's zoom in. Right. So this was the last down candle, right? Before the up movement. Now, this same candle, right? The same candle was broken in, right? And then mitigated. So this order block over here is no longer a valid order block. It's this candle that we're looking at now over here. That is now a valid order block. This candle over here. So if you look at this order block over here, it's that candle, that's the order block. It's this candle that is the demand zone. And we can see price bouncing off that level, right? Now, if we look carefully, we can see that this only got broken by this candle, but nothing came down to mitigate it. Right? So there was no mitigation to that candlestick. All right. So this is a valid order block and a valid demand zone. Next level. Right? This last down candle before the move up. Right. Let's look at this candle. Right? Was it broken to the downside? No, it wasn't. Right? None of these candlesticks broke it to the downside and came back to mitigate it. So is this a valid order block? Yes, it is. Right? So what are we waiting for? We're looking for price to come back down, and at this level, we should get a reaction. Whether the market does something of this sort, right. Whether the market comes down and perhaps the market, let's look at structure, perhaps the market comes down and we retest that level, come down, bounce off, bounce off, bounce off, and then bounce up. Right? That could be a structure that we could see taking place. Right? Why? Because all of those levels are valid. Right. Let's get back to it. Why are these levels valid? Let's look closer. Now, if we look at this order block, we can see that this was the last down candle but nothing came below that candle, right? Nothing came below that candle. So was this candle mitigated? No, it wasn't. Once again, this is a valid demand zone. Again, let's look at this candle. Did anything come below that red candle? No, it didn't. Was there mitigation? No, there wasn't. Right? No, there wasn't. Is this a valid zone? Yes, it is. So guys, what I'm trying to explain here is how you can differentiate between zones that are going to hold and zones that are not going to hold. Now let's look at a zone that won't hold. Right. The last down candle before price moved up. Right? Let's draw that out. Where was this down candle violated? Right? Well, if we have to look carefully at this price action right now, as we zoom in, we can see that that last down candle was violated roughly over here. This is where price broke the high, right? And then what happened? Price came down, went up, and mitigated it. Can you see that? Price came down, and we mitigated that order block. And this is now no longer a valid supply zone, because that order block has been violated. Does everybody understand a little bit more on how to identify levels that are going to hold and levels that will not hold? And why it is we always see levels holding and levels not holding, and you're like, hold on, that level should have held. But then you find out that it didn't hold. And the reason it didn't hold is because it was already violated. Understand? That level was already violated. So when you thought that, wait a minute, this level is going to hold and it breaks right through, it's because we didn't see that that order block has already been mitigated. That level was already mitigated. Right? How could we see that? They mitigated this level completely. Right? So here, right, you can see in that once we came in, we mitigated it. Right? So we basically had like a buffet. So we ate a little, right? Then we ate some more, and we ate some more. And then as you can see, as price comes down to this level, you can see that price never came back to this level. Price never came back to this level. Why? Because at this level, we've already eaten. They've already taken out their negative orders. The orders that were in a negative, right? Or that were going to go into a negative or went into a negative, they pulled out of. So as price went up, those sell orders were in a negative. So they then came down to clear out a few, right? So they went up, cleared out a few before price pushed up higher, So they needed to come down to clear out the rest. And as you can see, that's the mitigation. And from there was no reason to go any further, and so they went up. We're all on the same page. Do we all understand what mitigation is? Do we all understand that we should always check? So even though, and I want to get into this, I'm going to get into it deeper, right? Even though we might see that on a 1 hour chart, right, this level is not valid, right? This level is not valid, but on the higher time frame, this being the last up candle before the down movement, right? We can now say that, okay, fine. Was this level mitigated, right? So this candle broke out, this candle mitigated, right? So there is no level that's going to hold at this level, right? So the last down candle, right? As we can see over here, this candle violated that and came in and they mitigated it, right? If you look over here, that push up, right, just violated that level. So when they pushed down, they mitigated out of those orders and price pushed up higher. Right. Now, let's look at the last down candle, which is this one over here, right? And see I don't know why my network is so crap, but anyway. Right. And see what is happening. So as you can see now, guys, so we really have no business up here. There's nothing over here that's sustainable. We're getting nowhere here. Right? However, though, we have this huge imbalance where price is unfair to the market. From this level to that level, we have insufficiency in price. Price is unfair. So we would definitely see the market coming in for a quick munch. So the market will munch 50%, pull back, and munch the rest. Right. So it's like a buffet. They eat 50% of the food and then they eat the rest. Right. And then we could probably see this order block, right, hold, but to the downside. So we might find out that this order block holds to the downside, right, where you find out that the market respects that order block, right? The market respects that order block, right? Since it hasn't been mitigated, it respects that order block, but to the downside. And price continues to then fall. You get me? Are you with me? It's grabbed liquidity, guys. Here. It's grabbed liquidity, right? It's grabbed liquidity. This was the last up candle, right? Before the down movement. Right. So this level still needs to be mitigated. So we could probably see price push up and then push down. So everything that we're seeing is showing us bearish movement. We are getting bearish movement. That's all we're getting. All we're getting is bearish movement. Now, if we looked at a wipe off scenario, right? If we looked at a wipe off scenario and the three phases of a market, then we could see what's happening here, right? So we had a level, right, where we were, oh gosh, I need to fix this laptop. Oh, sorry guys, I need to fix this laptop. Anyway, right, let's look at this. Okay, so let's look at order flow. Let's look at a Wyckoff schematic here. So you can see over here that we had a level where we were in a distribution phase, right? We distributed, smart money pushed money up. Guess what's happening now? We're at a level where we're looking for a distribution. So if we had to look again, we'd probably see this as the secondary test, right? The test, smart money pushes price up, right? A bit of a reaccumulation over here before smart money continues, and then we get the distribution phase. And at the distribution phase, we then see smart money distributing price in order to push price higher. And once again, down here, we would see a similar situation from there to there. Right? Because if we look at these levels, on a smaller time frame, then you'll understand what I'm talking about. So now we can see another sign of Wyckoff. distribution, now it's not always going to be as big as the one up there, right? But at the end of the day, it's still market structure. Once again, what did we get over here? Some reaccumulation. Some reaccumulation. As price was delivered bullish. Now we're trapping some buyers. We're going to get the distribution phase. Get back into this level. And as we go up, get some more reaccumulations. And then back down. Now what you guys must understand is they will never take out these lows. Because if they had to take out these lows, oh my gosh, this laptop. Okay. If they had to take out these lows, right, then the major banks would be in a loss. They would be in negative positions, negative amounts of money. So they will never take out this low. So we have a low, a higher low, and even a higher low, respecting institutional lows. Because at these levels, we get some order. We'll have some order blocks. We'll have levels of supplier, right? And some demand zones. And this is how the market works. Continuously, over and over and over again. You with me? But now let's look at this on a 1 hour chart. Well, it doesn't look the same now, does it? Or a 4 hour chart. Now let's look at the low that they've respected. There's the low. As you can see, that same low has been respected. And the low previous to that was respected. And the low previous to that was respected, was respected, was respected. That final low was respected. So when the market started to push price at this level, they created a low that would be respected by that previous low. And as price went up, and we had a Wyckoff schematic and price was distributed and price started to push higher at that order block, we created a low. So they put in a low just to put in a high, to put in a low that would respect that low. Put in a low, put in a high, put in a low, put in a higher high, put in a lower low, right? And then you can see that they failed to put in a higher high, but still respected that institutional low. And as price went up, they put in a high, put in a low, put in a high, put in a low. But as you can see, the other lows previously were respected. So, guys, this happens on all charts. Even if we went to a 15-minute chart, right? So what I can say is this low will be respected unless they're planning to go bearish. If they're not planning to go bearish, then they will respect that low. And this is order flow. This is how the markets work. We're on the same page. Everybody understand? If we had to go to a 5-minute chart even, right? And we had to look at the lows and the highs, then you would see what I'm talking about once again. Right? We had a low, right? We had a low, a high. A low, a high, a low respecting that previous low, a high, right? A low, where this is now fake liquidity being created. A high, I'm not going to go all the way up. A low, a high, a low, fake liquidity created. Now let me explain that to you. Fake liquidity created was when the institutions create a level of liquidity, right, that they create themselves. So everybody here can get in. Let me just open this up quickly. Right. So here you can see there was a low that was respected and a low, right? But this isn't a low that we know as a low like this. So this here was actually a low that triggered buyers so that when smart money pushed price higher and distributed, they would take out everybody who was buying. Everybody who was buying over here was taken out as they distributed. Right. Same thing that happened over here. Right? We have this high. We have some liquidity at the top over here that we're looking for smart money to take. What did they do? They took it right over here. Right over here, they took out that high. And everything that was left behind was taken out by that high. Yes, if a high is created, unless they're planning to go bullish, they will respect that high. Now, if we look at recent price action, guys, you can see that once we had this high, we had this liquidity, Price came in, took out everybody who was trying to buy the market. So everybody was trying to buy the market, right? Got taken out. Everybody was trying to buy the market, sell the market from this level, got taken out, right? So stops were hit, taken out. And now we can see that the lows are getting lower and the highs are getting lower, which means that now, right? What I'm saying is the highs are being respected. This high is being respected. Because what we were expecting was price to push in and then price to push down. But in order to show that the sellers are weak, that the buyers are weak, not the sellers, that the buyers are weak, right? They showed their strength. Where did they show their strength? They showed their strength right over here, when they couldn't even take out that previous high. Never mind this high, but this high. So now we can see that they're respecting this high. So should price perhaps drop lower, then we could see a situation where now they come and maybe tap into some order block or level at here and fall into that level, push up, and then fall lower. Right. Because if we look over here, this whole level is a distribution. If we look over here, everything that's happening at this level is going down. Everything that is happening at this level is going down until it goes down further and further. And then we might get a pushback up and we can see price going down further and further. And if we go out completely, we can actually see what's really happening. Now you can kind of see what's happening. So we can now see price taking out lows. So now we put in a low, we put in a high. Right? We put in a low, what do? We put in a high, put in a lower low, put in a high, put in a lower low, until price turns bullish. How do we know price is turning bullish? When price breaks this high. Price needs to break this high. So once price breaks this high, right, we'll see price making a high, putting in a low, putting in a high, putting in a low, putting in a high. And that way, price has turned bullish. What were we waiting for? We were waiting for this high to be taken out. Because at this level, they distributed. So at the same level, they would make a decision, and should price push up, right, they would respect that institutional low, put in a low, put in a high, respecting that high, and putting in a low, respecting that low. We're all on the same page. Does everybody understand what I'm talking about? Are we all grasping this? So when you want to trade, guys, when you want to trade and you see that they're putting in an institutional low on a 5-minute chart, your stop can be at the bottom of that, and that will be respected. Right. So what is an institutional low? Now let me help people out here. We get 3 different retests, right? It's what you take into consideration as a low, right? Now, if we have something of this nature, would I consider this a retest? Maybe not. Perhaps this? Well, that might be a break of structure. That not so much. Right? Because what this looks like, what this actually looks like is basically a candlestick, a green candlestick going up, and then a little red candlestick over here. And then obviously green candlesticks going up. So would I consider this a retest or correction or a pullback? No, I wouldn't. Reason for that is because that one red candle in the middle over there, yeah, I don't see that as a pullback. This, on the other hand, that would be a correction. That would be a pullback, and I would consider this a break of structure. Again, we have something of this nature. Now that is a pullback. Now that is a pullback. Right? That is a pullback. When I see that, that's a low. That's a low I know will be respected. That might be a low that will be respected, but I'm not guaranteed. But that's a low that I know they're going to respect. That's a low that I know when they come back down and put in a low, that low will be respected. Make sense? So this low, that pullback won't be respected. And that's why we see situations like this, and then the market comes all the way down, breaks that low. So what do we consider a breaking structure? When institutions are putting in a low, this to me is a low. Because remember, guys, that within this box, they can put a low anywhere within this box, but not break out of it. So they can put a low over here. Right? Sorry. Right? So if this is the institutional low, right? If this is the institutional low, this here, within this box, it can come over here, over here, over here, over here, right? But as long as it respects that previous low, I'm happy. And the same thing would happen over here. It can come in over here, over here, over here, up there, over here, but respects that institutional low. And as price continues to be delivered bullish, we will continue to see this type of price action until they deliver price bearish. And once they deliver price bearish, right, it's when they're coming to give you that grab, where they grab this liquidity. Because now remember, right, remember that they come in to mitigate out of these orders. They come in to mitigate out of these orders, right? So who are buying at this level? We are. Smaller institutions are buying at this level, buying at this level, buying at this level. Where are their stops? Below these levels, below this level, below this level. So this whole area is basically a pool of liquidity. And we can see the market then coming down, and from there, pushing right back up. Right? But the minute you see price breaking this low, the minute you see price breaking your previous low, you can expect price to break that low and that low. And that's how we determine that the market is going to fall, or where the market is going to fall. You with me? That can happen on a 1 minute, a 5 minute. The lows are respected. This low over here, right? This is a 5 minute chart, guys. A 5 minute chart, right? But once they put in that low, and they put in a high, they put in a low, a high, a respected low, a high, even though price went all the way down for a perfect, retest, they continue to respect the lows until they broke this low over here. Now, my question is, did they break that low? Let's see. They did. So obviously at this level, right? There was a lot of liquidity, and they're looking at volume. Right? And you probably find out that the institutions that pushed price at that level had some kind of order block laying over here, came to mitigate that order block, came to take out all the stops. Everybody trying to buy into this market, and from there, push price higher. From there, put in a high, put in a low. Now we know that this low is the institutional low that we can now see being respected. And we won't see anything come lower than that. As you can see, price just shot up from there. That low, below that was your stop loss. Price pushed up, and that low was respected. We're all learning. We're all learning. Now let's look at something else. Right? We can see here, I'll show you guys now. We had a distribution phase. Right? And then a push up. Then a push up. And we had another distribution phase. As price pushed up. Into, hold on. Price pushed up. We had a distribution phase. The accumulation, where they made a decision. Price then pushed up. And once again, what did we do? We made a decision. We agreed to push price higher. All right, so let's look at these levels here quickly. Right, so let's quickly look at these levels. Today, I'm mostly going to work on structure. So we can see over here, they made a decision to push price lower. Over here, made a decision to push price higher. Over here, made a decision to push price higher. Over here, made a decision to push price higher. And once again, decided to push price higher. Now we've come to this over here. Right? What is the decision? Now, because of the way price action is being delivered, this is telling you that they are trying to get as much liquidity at the top over here to quickly spike in, spike down. Now, this might not happen this week, but remember, we have NFP coming up. We have NFP coming up. So they might, for the next week, create enough liquidity at this level so that when they finally grab it, they'll push price so low, taking out institutional order flow. So here they're going to make a decision. Right? What decision are they going to make? Are they going to make a decision to go higher? Or are they going to make a decision to grab that liquidity, take out all these highs, and as they grab that liquidity, fall? And when I say fall, I mean fall, where we see massive institutional candles developing. Or we could have a scenario where they come in to sweep these lows. Remember, there's orders. There's orders at these levels, right? So when they came down, right, what did they just create? They created liquidity. Because everybody at this level is planning to buy the market. Because why? We buy low, we sell high. So it only makes sense that market would come in, grab that liquidity, push up, grab that liquidity, take out that low, take out that low, and as time goes on, taking out lows. We're on the same page. Why do I say this? Because at this level, right, what are they going to do? They're going to create a level of liquidity. Right? And at this level, we've got people buying, we've got people selling. So we've got people over here who were selling the market, right? But that would be an institutional high that they would come back to later, but that would be the institutional high that is respected by the rest of the highs. And now, over here, we have order flow. Who's over here? We've got buyers. We've got buyers over here. They're buying the market. Right? What do we have over here? Buyers. As long as we have buyers at this market, we have liquidity. Money. Money for the movers. And that's the market movers. Money, money, money. So what do? Come down, take the money. Or if they don't take the money, right? If they don't take the money, they're just creating, right, more traps to collect more money. They're just creating more traps to get more money. So now we have buyers over here. and some liquidity over here. Right? So we have buyers. As they come down, they liquidate the buyers. As they come down, liquidate the buyers. As they come down, liquidate the buyers. And finally, they liquidate everything. Right over here. Right over here, they liquidate everything. Right? But now, what have they created? Well, now, if we have to remove all the drawings, what did they create over here? They've created liquidity. Why? Because at this level, guess what? At this level, yep, you guessed it, we have liquidity. We have stops laying at the bottom of these levels. Right? So all of this has been taken. But now we have liquidity. So we can see the market pushing down to take out that low. Because once they take out that low, they can then push up higher. Because what are they doing now? Well, now they're liquidating the rest of the buyers. Sorry, the rest of the sellers. You with me? We're all on the same page. And then what happens? We mitigate this level in order to get more buyers to jump into the market. And as they jump into the market, we take them out. And as sellers get in, we take them out. As buyers get in, we take them out. Liquidating buyers and sellers as we do all the time. It's a liquidation market, guys. This is what we do. This is what smart money does. They liquidate every opportunity they possibly can. Banks against banks, institutions against institutions, bigger institutions against smaller institutions, hedge funds. Everybody is in the jungle together. You with me? Now, obviously, as time goes on, I'll get into Wyckoff and explain a few things, your STs, your secondary test, your test, but that's all for another day. However, though, Wyckoff is playing all over here. There's a Wyckoff within a Wyckoff, like there's an order block within an order block, a level of supply within a level of supply, a level of demand within a level of demand if we go to a higher time frame or a lower time frame. That's just how it works. So just because a lower time frame level order block Wyckoff is playing out, it doesn't mean the higher time frame will play out. Because on a lower time frame, this is current price. This is what's happening right now. This is price action at its finest because this is what's happening right now, exactly what price is doing right now. Whereas if we looked at a 1 hour time frame, each candle represents 1 hour. So how many 5-minute candlesticks would we get in 1 hour? Well, let's put it to a test. So let's take a 1 hour chart so I can show you something. let's take this 1 hour candle. Let's mark it out. Let's mark out this 1 hour candle. Right? And let's look at price action there on a 5-minute chart. Well, now we can see what price action was being delivered on 5 minutes. It didn't look like this on the 1 hour chart, and it doesn't look like this on a 4 hour chart. Right? So when we're looking at price action and how it's being delivered, whether it's being delivered bearish or bullish, we can't say right now, because this was the institutional low that was put in before price pushed up, put in a low, maybe to fail to put in a high, or to put in a high, to put in a low. Or we go bearish. Why would we go bearish? Because at this level, we've got money. And to be honest, all of this from here to there is insufficient price. And all of this here is money. From here to here. From there to there is price. Hence I said price would be delivered bearish to this level, which is exactly 50% as they munch, right? And maybe at this level, we might find some kind of consolidation as they munch the rest. And maybe push up or push even lower. Right? Because this was the last down candle before the up movement, and we haven't mitigated it. This is a level of demand where price might see bullish movement. We're on the same page. Is this all making sense, guys? Is this all making sense? So basically, jumping onto smaller time frames just means price is being delivered in a certain way. But like I said, just because an order block or a level of supply or demand doesn't hold on the smaller time frame, it doesn't mean it won't be respected on the higher time frame, and vice versa. Just because it was violated and not respected or won't be respected on a higher time frame, it doesn't mean the smaller time frames won't be respected. Anyway, guys, I'm out. I hope everybody learned something. I hope we're all on the same page. I hope we've all grasped, something new for today. And tomorrow we can all have, a new financial day where, things are brightened up and we all go in and backtest, guys, backtest. Guys, if I can tell you anything, like I said earlier, your risk management is your setup, right? If you don't want to use a stop loss because we know that there are stop hunts and the market knows where your stop losses are, the only thing that is better than that is respecting your setup, right? Acknowledging that your setup is everything, right? It's as simple as that. Respect your setup, acknowledge your setup, right? And acknowledge that you're not going into a market to lose money. You're going in to win money. I don't go into the market and say, oh my gosh, today I'm going to lose money. No. I go in the market and take it by the horns and say, today I'm taking you down. That's the attitude I have when I go into the market. I go in, I analyze, and I'm like, okay, fine, this is where the market's going to. I am coming for the market. Anyway, guys, I hope you all learned something new. Have faith in your setup, man, guys. Have faith in your setup. When you analyze, don't, how can I say this? Neglect your thoughts on the charts. Neglect your thoughts within the markets. Don't let negativity come in, because that's going to mess up your trading day. You understand? Just have confidence in your setup. As long as you have confidence in your setup, your trades, your trading day, your trades in general, according to your setup, will be profitable. Why? Because you have confidence in your setup. You've obviously analyzed, you've obviously done all your homework, and you definitely know now what's going to happen with the market, why the market's going to go to this level, why wouldn't the market respect that level, why wouldn't the market do 1, 2, 3. So having confidence in your setup is the only risk management you honestly need. Anyway, guys, I'm out. This is Marco the Entrepreneur. Peace.